Hello and welcome to the Deduction, a Tax Foundation podcast. I'm your host, Kyle Hulehan, and we're back today with another episode, and I am joined by my co-host, Erica York. And today we have two guests joining us, Daniel Bunn, who's the president and CEO of Tax Foundation, and Jared Walczak, who is the vice president of state projects here at Tax Foundation. So we have a wonderful podcast set up for you guys. 2025 was kind of a big year in tax. There's the one big, beautiful bill, tariffs, the property tax revolt. Kind of going to recap all of that and talk about what happened this year together. So to start this off, I am going to send it over to a combination of, I'll send it to Daniel first, I guess. The one big beautiful bill was sort of the defining legislation of 2025. Could you maybe walk us through what it actually accomplished versus what was promised? And, what does it mean for the average taxpayer?
So this year, certainly the big news was federal tax legislation. It's hard to say tax reform. There are certainly some tax reform elements and some good things that we see out of the big, beautiful bill. But without action, if Congress didn't do anything this year, 62% of American households would have seen a dramatic tax increase. And that was what drove the efforts. The president was interested in fast action. The fact that the legislation, took really, once the published legislative documents were in process. It took roughly 2 months, a little bit longer, and depending on how you measure. But the speed at which Congress acted was impressive, and it resulted in permanency for a lot of provisions that are going to support research and development, business investment, and just understanding of what the tax landscape is going to look like for a lot of small, medium, large-sized companies across the landscape. On the individual income tax side, it made rates and brackets permanent. It increased standard deduction, had a little boost to the child tax credit, and brought in a few new things to the tax code that, we're kind of skeptical of, if not, really questioning whether they belong in the tax code. Things that internally we call the no tax ons. So no tax on tips, no tax on Social Security, but it's not really a no tax on Social Security, and then no tax on overtime, no tax on auto loan interest. Those policies were certainly designed with a lot of campaign promises in mind. The reality on the ground is going to be really challenging for taxpayers, especially when they're filing early next year, because for overtime and for tips, the type of reporting structure that would make it easy for taxpayers to claim these deductions isn't really in place. And that's going to be a challenge going forward, and really a question of the principle that we talk about at Tax Foundation a lot of times, tax neutrality. If privileging these taxpayers is really the way Congress wants to go, then that's in the opposite direction of neutral tax policy. So there's a lot of things that were in the bill. I think another big question that I have, and this is going to be an ongoing issue, and it's not a new issue. We've been talking about this for a while, but the federal budget situation is not great. The trajectory is to just, never-ending additional debt. There's not really any sort of sustainable fiscal policy on the radar. Lawmakers really need to make some tough choices to accomplish that. And they certainly did not do a lot on that front in the big, beautiful bill. And that puts pressure on future debates very, very soon in the coming years.
Real quick, I'll follow up to you, Erica. I have a quick question. Why does the debt matter? People kind of bring it up. I hear people ask me, or why does the debt matter? Why does it matter? Who cares? It's all fungible. Could you kind of break that down quickly for us?
Yeah, just two quick things. One is the idea of fiscal capacity. If you look at the federal budget right now, one of the biggest line items is becoming interest expense. We spend more on interest than on defense, than on some healthcare programs. And the more money goes to just paying interest on the debt, the less you can invest in things that the government actually wants to invest in. So there's just this real-time right now fiscal capacity issue. There's also, I think, becoming more real and in sooner years too, this issue that debt could spiral out of control and we could have an actual crisis on our hands. I don't think we're there today or tomorrow, but when that happens, the things that happen to interest rates, that all becomes very real for people very fast if you are in a debt crisis. And then I think I'm going to add a third, even though I said two, when we look on down the line in the early 2030s, what's going to be happening to Social Security when those programs become insolvent? I mean, if Congress does nothing, benefits get cut. That's a real impact for everyday Americans if Social Security has to get cut. Now, it's not likely that that happens. Congress is probably going to act and do something. But that do something involves either higher taxes or less spending elsewhere. Both of those will have real ramifications for American taxpayers, for people who receive benefits that may be subject to getting cut. And the sooner that Congress can do something about that, the less that adjustment has to be. So all of those things, fiscal capacity, the potential of a debt crisis, or just people losing their confidence in, in treasuries, losing confidence in investing in America. And then ultimately, what are the policy decisions Congress makes? All of that will have a really real impact on people. Daniel, I want to go back to one of the things you said about OBBBA or OB3, as we like to call it. You said you wouldn't really call it reform. And I think maybe one of the reasons why is like the motivation for why Congress had to act this year. If we go back to 2017, when the Tax Cuts and Jobs Act was enacted, the motivation for tax reform had been building up for some time. Our corporate code was really uncompetitive. We needed to make changes to simplify the individual tax filing system. And so it resulted in what I think most people fairly call a tax reform bill, though it did have those odds and ends that we would say weren't good. But this time around, the main motivation for Congress was these tax cuts made back in 2017 are expiring and we have to do something, or those 62% of taxpayers see their taxes hiked. So it was less of this like overall vision for how we need to reform the code. It was more of, hey, we need to do something. Even with that, though, I think that doing something, that permanence is a really important issue, maybe not quite motivation enough for tax reform. So can you talk some about that motivation? Why was permanence important, but why did it maybe still fall short of resulting in like a really ideal legislative outcome?
We talk regularly about the difference between just doing tax cuts or actually doing tax reform. And with tax reform, a lot of times the way we think of this at Tax Foundation is you're trying to rearrange the tax code to achieve probably similar levels of revenue, but in a much more efficient way. And with the Tax Cuts and Jobs Act, you saw a lot of tough trade-offs, especially on the business side of the tax code, to provide incentives for investment and a little bit of, shift on the way that businesses, different types of businesses were treated, dramatic shifts on the international side. But what we see in 2025 is legislators essentially picking up most of the ideas that were good in 2017 and carrying them forward permanently, which I think, as to your point, is excellent. But then the new things that were done this year, it's hard to see any of those things as true tax reform. Like there are narrow tax cuts for small pockets of the population and expansion of tax cuts for small pockets of the population. I think of the expansion of the SALT deduction relative to prior law, the no tax-ons that I was mentioning, and even the Trump accounts. Like all of these things are not necessarily reforms. They're just additional tax cuts for certain slices of the population. And the Tax Foundation, we think, broad bases and low rates, and this is not necessarily moving in that direction. There is kind of a silver lining, though, and I think one of the under-discussed items in the Big Beautiful Bill is this new cap on the value of itemized deductions. So, even if you're in the 37% bracket, those deductions are valuable to you at the essentially 35% rate. And I think that's an element that I would like to see lawmakers carry forward. One of the big things of the standard deduction, the expansion of the standard deduction means there's far fewer people itemizing now than kind of ever in the last probably 50 or 60 years. And being able to carry that forward with even broader bases for itemizers, with saying we're going to limit some of the value of itemized deductions at the top of the income scale, with that eventual goal, hopefully, that we end up with a cleaner income tax base at the end of the day.
Erica briefly touched on some of the debt and deficit stuff, but I am wondering, how much does this cost, this legislative OBBBA? How much is it going to cost us, and what's it going to add to the deficit?
Yeah, it's not great. So there was a whole debate about how you measure these things. At Tax Foundation, we measured this the same way we measured the Inflation Reduction Act or the Tax Cuts and Jobs Act. And if you look at the changes lawmakers made relative to the expiration scenario, you're looking at a multi-trillion-dollar tax cut. So on a conventional basis, so this is without taking in the economic effects, this is over $5 trillion worth of additional tax cut. And then if you look at the dynamics, there are certainly some things that are great for the economy in this. You can shave off about $1 trillion of that, so you get closer to $4 trillion in reduced revenue over the next 10 years. And then I think it's worthwhile taking into account some of the spending cuts that were baked into the bill, and that gets you down to around $3 trillion deficit impact over the next 10 years. So it's a massive fiscal shift, relative to prior law. And there were certainly options on the table, and we wrote about many of these options to narrow that deficit impact, and lawmakers chose not to go that route. But it'll, just to Erica's previous point, increase pressure on other parts of the budget, either because there's higher interest costs, or you're just essentially crowding out key priorities for legislators, assuming, and this is, unclear, assuming that there is still going to be some pressure from the markets to promote some fiscal discipline in Congress.
Yeah, maybe for the video viewers, we can pop up some of the charts that our colleague Will McBride just put together yesterday showing fiscal trajectory. I think he called one of his charts extraordinary deficits sustained and worsened under OB3. So that kind of summarizes what happened on the fiscal front. But I want to shift over to Jared and ask you, because all of these changes at the federal level, they're not happening in a vacuum. They will have implications for the states. And so what have we seen so far from states responding to these changes? Are they conforming? What's happening to revenue forecasts at the state level because of these changes? Can you walk us through that?
Yeah, absolutely. So there's some uncertainty in state capitals right now. Most legislatures aren't in session. This varies, but most states are only in session a few months out of the year. So in most cases, they're coming back in January or maybe in February. So this is very much on everyone's mind. It's something that revenue officials are working on right now, but they are thinking about what this looks like next year, even though for many states, these provisions actually have already gone into effect, or at least some of them already have, because a lot of this is as of 2025. So some states have rolling conformity where whatever changes happen at the federal level to the Internal Revenue Code, unless there's something that already decouples from or modifies that provision, they adopt it just automatically. Other states have static or fixed date conformity, where lawmakers have to update the conformity statute to bring in those new provisions. And right now, there's some discussion of some states maybe pausing that, taking a little longer to conform as they figure out some of these details. But even beyond that, whether you're rolling or static conformity, states are exploring whether they want to decouple from or modify specific provisions. There are 7 states, those that begin with federal taxable income as their individual income tax starting point, that would automatically bring in some or all of those personal deductions that Daniel talked about. So that's the higher senior standard deduction. A few states would bring that in. The states would bring in the tips deduction, overtime, auto loan interest. These are things that most states won't automatically bring in, but 7 potentially will have some combination of that. In the realm of Congress doesn't always think about the states when doing these things, auto loan interest is a kind of fun one. Fun and perhaps not the typical use of this term. It's a complicated one. There is, as you may know, you all know, there's this provision that says that final assembly of the vehicle has to be in the United States for there to be eligibility for this deduction. Congress, federal government can discriminate against foreign commerce all they want. It may not be good policy, but they are free to do it. States cannot discriminate against interstate or foreign commerce. So it's pretty likely that that is unconstitutional if states follow what the federal government does. So either they have to provide a benefit that's broader than the federal one, or they potentially face litigation. So states are going to be grappling with whether they want the cost of those provisions. Then on the other side, you have these business expensing provisions that Daniel talked about. And the big ones, the big ticket items for research and experimentation and for 168K, basically that machinery and equipment first year expensing, what we typically called full expensing, these are restorations. But again, where when Congress does something, states sometimes experience it in a different way. These feel new to a lot of states, especially that R&E piece. For 68 years, it was in place. This was an Eisenhower administration policy. You had it from 1954 until 2022. Every single state, as far as I can tell, conformed to it the entire time if they had a corporate income tax. No one really questioned this. Everyone believed that you should not penalize or discriminate against research and development expenditures. But with that 5-year amortization that went through as a pay for in the latter part of the Tax Cuts and Jobs Act, one that I think that lawmakers thought would be dealt with in extenders earlier than it was, now this looks new. And there are some timing costs. So states are looking and saying, wow, we've got a new cost here for the next couple of years. It'll be in 2025, 2026, maybe a little in 2027. And some states are thinking about decoupling from that. I think that's really bad policy. Once you're on this track, most of it is timing effects. So the costs are pretty minimal in the out years, but it's good policy. When you think about the cash flow of businesses, when you think about not penalizing things like research and development or capital investment, this is what we want. But we already have Pennsylvania that is decoupled from that R&E provision. DC has decoupled from it. Michigan has hit pause for 3 years. And honestly, the experience of hitting pause for 3 years is that that same first year cost that you have to get over will exist 3 years from now too. So they're just kicking the can down the road. So those are the debates that we're going to see playing out probably in many more states this coming year, even though in many cases it's already happened. Like even if you're thinking about decoupling from these provisions next year, you have businesses that are already adjusting their estimated payments right now in tax year 2025 based on this. So it's already showing up.
And now, real quick to follow up on that, is it just state to state, like whether it's better to conform or not, issue to issue? Is it in general better to conform? How does that work?
Conformity is a good thing overall. States do not want to reinvent the wheel on tax policy. They want to be able to rely on the federal audit function, which is way better than theirs. They want the same definitions to generally apply. If there's a court case or a regulatory matter that affects the interpretation of a policy, they'd really like that to be the same. And for multi-state taxpayers, particularly for businesses, they also want things to be similar, that if there's a rule or a definition that applies in one state, they'd really like to get the same answer in another state. So every state makes some modifications. Every state goes its own way on something. But you want as much of it as possible to align. California had been 10 years out of date on its conformity, and it updated this year to early 2025. So pre-OB3, but still updated 10 years. Over 1,000 business provisions changed when they did that. So think about that. If you're a corporate taxpayer and you have to adjust over 1,000 elements in your tax filings to match what California does, and the uncertainty that if there is a court decision that affects something that was slightly modified 3 years after, but it's still mostly the same, does it apply to you or not? So conformity really matters. But you don't necessarily have to conform to everything. No one conforms to everything. So if you wanted to go your own way on tips, for instance, and say, the federal government is offering that, we don't automatically, so we're not going to add it, or even we are in line to, and we're going to choose to decouple from that. I think that's perfectly reasonable. I don't see that as a policy the states should be jumping on board. On the flip side, when we talk about these expensing provisions, they're really getting to that question of what is net income? What is profit? It is neutral tax treatment. So I would certainly hope that states stay the course on that and do what most of them have been doing for many, many decades.
Yeah, I think it'd be very unfortunate if we had a situation where states did not conform to R&D expensing or bonus depreciation. And, some of the best research, like academic research we have on the benefits of expensing, exploit the differences in state level policy. And they find that the states that have this, those businesses invest more, they hire more. And so we know it's a really beneficial policy for states to have. And there's the simplicity argument too. Don't do something separate than what the feds are doing when it comes to these capital investment and R&D provisions.
Now, we've had a lot of talk about the One Big Beautiful Bill now, and we're going to transition to something that's a little bit feels like our wheelhouse on the deduction podcast. It wouldn't be a deduction podcast if we didn't talk about tariffs. So, Erica, Daniel, Jared, if you want to hop into, that'd be great. We can all talk about this. President Trump's Liberation Day, marked an aggressive expansion of tariffs. So maybe, Erica, I'll start with you. Could you just dive in and explain some of what we think the administration's rationale is for these tariffs and maybe how that doesn't align with economic reality? But I'd love for you all to jump in on this.
Yeah, happy to kick that off. So the Liberation Day announcement was framed as a response to other countries' unfair practices. But if you end up looking down into like the formulas that the administration used to determine these tariffs, if you look at the way the president talked about the tariffs, a lot of it is just a fundamental misunderstanding of bilateral trade balances, thinking that if we buy more from businesses in a given country than they buy from us, then something there must be wrong. Or something there is not wrong. It could be they specialize in something we need. It could be that we are a lot richer than that country. It could just be a lot of different factors that have nothing to do with trade policy itself. Nevertheless, that is what the Trump administration targeted, these bilateral trade imbalances, to set very high tariffs, reaching up to 50% for some countries, threatening tariffs of up to 145% on imports from China. But if you look at what was actually threatened on Liberation Day versus what's been implemented as of November, December, the actual implementation is about half as much as what was threatened. I think part of that is due to just the unsustainability of rates as high as 145% on China. It was very clear, very fast that would be disastrous. If you looked at what happened to container bookings and that sort of thing when those tariffs were threatened, it would have been just a very chilling effect on those trade flows almost overnight. And then some of it, I think, is that maybe it's marketing. When you campaign on saying you're going to have a 20% universal baseline tariff, that sounds very dramatic given where tariffs have been in the United States, an average of like 1.5% prior to the trade wars. And then you threaten tariffs of 50%, 100%. It actually sounds a lot better when you say, okay, it's just going to be 20%, even though that is just a drastic increase in tariff policy. So that's about where we've settled. Average tariff rates, some bouncing around like 11 to 12%. When you look at the actual tariff revenues that are coming in as a share of imports, which again is about 10 times higher than they were prior to the trade war. So very high, but a lot lower than what was threatened. Now, the bulk of that is up in the air because, of course, we're awaiting the Supreme Court decision on whether these Liberation Day tariffs, this other bucket of tariffs on Canada, Mexico, and China related to border security and fentanyl, those could be ruled illegal, which would potentially wipe those tariffs out. So we're at again, another uncertain point on tariff policy because of this pending ruling. And we may see tariffs change a lot in the new year, given the outcome of that court case.
I think another element to this is, like you were referencing, Kyle, like the difference in the approach between the OB3 and the tariffs. A lot of the administration's talking points are around reshoring or reindustrialization or new investment in the U.S., and a lot of those talking points line up with the policies that were adopted in the Big Beautiful Bill. The tariff agenda goes in the opposite direction. As we've written about, as Erica's written about, the manufacturers import a lot of intermediate goods. And if you're saying, well, we want more manufacturing in the U.S., but then you're slapping tariffs on the things that allow us to be a manufacturing powerhouse, then that's really contradictory. And not only is it contradictory, but the amount of changes that have happened. So the announcements on April 2nd, Liberation Day, that was really dramatic and caused a lot of chaos. But then it has just been kind of ongoing chaos since then. Thankfully, in the retaliation category, a lot of our trading partners have not responded in kind. Certainly, there's been some conversations with Canada and the European Union. A lot of their retaliatory approaches have been delayed or put on the back burner. With China, their approach to essentially making it very difficult for U.S. importers to get access to rare earth minerals has really changed the conversation with respect to what that relationship looks like. There's been a whole story around soybeans and the U.S., I think in the same week, China, there's stories about China buying more soybeans from Argentina and the U.S. bailing out Argentina, and now we're bailing out our farmers. It's been quite a mess in general.
And then I would just add from a state perspective that states have had a really good run ever since we came out of the Great Recession. Revenues recovered and then just kept going up and up. And particularly with the Tax Cuts and Jobs Act, which was obviously a net tax reduction at the federal level, but involved both base broadening and rate reductions. That base broadening flowed through the states. So states suddenly had a lot more revenue. Even when many states cut their individual and corporate income tax rates partially in response, they still had a lot more revenue. You look at the growth trajectories with this long sustained period of economic growth, with the base broadening that the Tax Cuts and Jobs Act brought, with some of the economic changes that it wrought that came at a cost to some degree at the federal level because, there were rate reductions and there were other changes that helped, induce some of this behavior, but it was just all sort of there for the states to take. They were able to just, see significant revenue increases, and they've been in really good shape. And the tariffs are really the dark cloud right now. When states are trying to forecast what revenues look like for the next few years, when they're asking questions like, are we comfortable conforming to R&E, conforming to bonus depreciation? One of the questions they're asking is, what are tariffs going to do to our economy? And that's really unfortunate that, we're shooting ourselves in the foot right as states are asking these questions about whether they should in fact conform to good policy.
So we touched a bit on the court case that's pending on the IEEPA tariffs, but can you talk some about the constitutional question there and what a ruling against the tariffs would ultimately mean for executive power over tariffs going forward?
Yeah, so the government is using an authority that doesn't even name tariffs. It has language on regulating trade, but using that authority to defend the tariffs that were proposed. And as you mentioned, not all of them were implemented or not implemented at the levels they were proposed, essentially the Liberation Day tariffs. And the oral arguments that happened last month gave some signals that the court is kind of skeptical, as I think they should be, of the administration's reasoning. But then it gets to your question of what happens if the court overturns these authorities? Well, we don't really know how the administration is going to act. They will likely, I think, look to other tariff authorities to replace the revenue. But if these tariffs, the IEEPA tariffs that we're talking about, get struck down, they would be required to rebate those tariffs back to the importers that paid them. And that's, probably on the order of magnitude of $100 billion. And we're also looking at a Q1 kind of tax filing season where you might have, with refunds plus new withholding tables because of the big beautiful bill changes, you could look at, maybe $100 billion injection into the economy on in that period as well. So there might be, even without Congress, lifting a finger in, the latter part of this year, might be $200 billion worth of money going back into the economy in Q1. And if the administration is still very protectionist and pivoting to other tariff measures, I'm really concerned about, where that clash of economic policies, where that flow of funds goes. I always, these days after the COVID era inflation, always worried about, new infusions of cash in times when supply is a little bit constrained. I don't know if we should be as worried as we should have been back during the CARES Act, but it's a period of time that we should definitely be paying attention to.
I'd be remiss if I didn't have us touch on one of my favorite tariff topics, which has to do with the tariff rebates or dividends or whatever we want to call them. And I mean, Erica, I'll pass to you, but Daniel's shaking his head right now, so I think he's got some thoughts on it. I'm
shaking my head at the horn that keeps going off.
Like the horn that keeps going off. Okay.
Might as well be the tariffs. Yeah.
Might as well be the tariffs. What is going on with the rebates? I think there's just this idea, to me, it seems like an admission that tariffs don't actually work if you have to send money back to people,
I think it's the way that the Trump administration is trying to grapple with economic sentiment right now. If you, look at surveys, if you look at what is concerning Americans right now, it's primarily affordability. Costs have not gone down. Costs are continuing to climb. The spotty inflation data that we do have, thanks to the government shutdown, has shown that it looks like inflation was actually accelerating in the period before the government shutdown. And then the Federal Reserve Chair has now come out and very clearly said that tariffs are contributing to rising inflation. And so I think rather than rethink the administration's signature policy, because I don't think we're going to be in a situation where Trump would change his mind on tariffs, they're thinking of how can we try to improve the way Americans feel about that. Maybe we say, hey, look at all these tariff revenues, and we claim that foreign governments are paying them, and then we turn that money right around back out the door and give it to Americans. So I think it's really this, what do we do about people not liking tariffs? What do we do about people continuing to worry about affordability when we can't actually take this policy off because it's our signature policy? Now, I don't think there's any chance in the world that tariff rebates are actually happening. The Trump administration cannot do that on their own. It would require Congress to act. And, Daniel just walked us through where we are on debt and deficits, how large of a deficit increase the tax cuts were. I don't think you'll see, members of Congress willing to deficit spend even more to send out stimulus payments to people. So I don't think the rebates are happening. But I do think they are a signal, like you said, Kyle, that the Trump administration is worried about how Americans are feeling, and this is what they're trying to do to make them feel better.
Yeah, that doesn't make me feel good. I when we talk about tariffs, I never end up feeling good. So I guess that's where we're at with it. Yeah.
Moving back to states and state tax issues, Jared, we've been seeing property tax revolts over this past year really gain momentum across multiple states. What's driving people's anger there, and what are the real world trade-offs if states or communities do try to eliminate property taxes?
Yeah, Erica, it's a great question because we've seen a property tax revolt before. If you look in the late 1970s, early 1980s, you see this first great property tax revolt. It starts in California. It spreads across the country. It yields a lot of property tax limitations, some of them fairly well designed, others, like the one that kicked it off in California, quite poorly designed and honestly creating some of the problems that we're now dealing with today that are leading to maybe further rounds of disruption. But there are some legitimate reasons why we're having this conversation right now. If you look at the rise in assessed values since about 2020, they're up over 50%. Even when you adjust for inflation, they're up by more than 25%. And that's a lot. And in some places, it's way more than that. If you go to some of the Mountain West states right now that have seen enormous population growth and therefore some real constraints with housing supply there, you can see properties that have doubled in value in 5 years. And if your property tax rates, if the mill levies have not come down, you're paying dramatically more for the same home. And I think you're asking a really legitimate question. Why am I paying twice as much for the same government on the same house? Those are good questions. And there are appropriate responses that governments can make, like having levy limits to automatically roll back those rates, or just making the choice at the local government level to provide rate relief. But what we're now seeing is that this, I think, very legitimate discontent is being married to a movement that has existed for a long time, but really below the surface, of people who just fundamentally oppose property taxes for a variety of reasons. Some of them are philosophical. Some of them are just, I think, the transparency of the tax itself. So this is the tax you know about, that you feel, even amongst ourselves, where we think about taxes a lot. Even in our daily lives, I imagine we think about taxes quite a bit. Erica, if I were to ask you how much you paid in sales tax this past year, what did you pay?
No clue.
But I bet most people can tell you what they paid in property taxes. It's a big number. It's all at once, or maybe, it could be an escrow, but it's a big number that you see once or twice a year. And it's just highly salient to people. So when it rises or when their assessed values rise, you have this reaction. And then you have some politicians who have really just latched on to this, and they've said, let's just eliminate it outright. You see this in Florida, Texas. You've seen movements in Nebraska, Michigan, Ohio, Wyoming, North Dakota. It's showing up in a lot of different states. And the problem is, I think people are being given half of a question. They're being asked essentially, wouldn't you like to not pay property taxes anymore? And the answer is often yes. I mean, people would generally like to pay less in most taxes. But the nuance is always, what's the alternative? So the question that's not being asked is, what tax are you willing to pay instead? And are you willing potentially to shift a significant amount of revenue authority and therefore to shift a significant amount of power from local governments to the state government? So I've looked at this for a variety of states. In Florida, for instance, you would need almost a 16% statewide sales tax to be able to offset the property tax. If you did it at the local level, you would have rates as high as 32.5%. In Ohio, you would need a flat rate income tax that by the time you add on the existing locals is about 12.6%. If that's crazy as a flat rate tax and you wanted to make it a graduated rate tax, probably make that top rate 5 or 6 points higher than that. So we're talking highest in the country by a significant margin. These are what you would have to do. You would have to, in many cases, more than double, maybe triple your income tax, more than double your sales tax. And then you have to decide how you're going to disperse that revenue back to localities. And that is, frankly, perhaps even harder because you have a few options. You could take the revenues that were collected the final year of the property tax, and you could just allocate that out forever, maybe adjust it for inflation and population. What you're doing there, of course, is you're rewarding the formerly high tax jurisdictions. If you have a wealthy community that had high property taxes, got high amenities out of it, loved their bargain, now they get that forever, but they don't have to pay for it. Someone else in a lower tax jurisdiction formerly that has lower amenities is subsidizing them. I don't think that's particularly tenable. Also, when we shift taxes, you're paying the income tax. Well, that's a hugely different distribution than the property tax. And if we use some other track, if we allocate this by population or by some needs-based formula, suddenly you're going to have jurisdictions that are collecting far less than they used to, and they have no recourse. They can't go back to their taxpayers. There's no property tax anymore. It's just gone. And they have bonded obligations. They have infrastructure that they can no longer maintain. And under any of these mechanisms, even if you adjust for population growth, I don't think it's adequate. When we think about growing jurisdictions, there are costs associated with growth. And growth is really good. We want growth. We want communities to grow in population. We want them to grow with new jobs and opportunities and business investment. All of those create costs, new infrastructure, new schools, all of these things, but they're good. And the property tax, because new property tends to be more valuable, it covers this. If you don't adjust for that properly, what you're doing is you are creating a huge inducement for jurisdiction to want to shrink, not to grow. You want a lower population. You want to turn that business investment away. You want to turn that new retailer, office complex away, because every time you add, you reduce the per capita amount of revenue that you receive. That's a terribly perverse incentive. And then finally, well, I could go on for a long time. I will make just one more point here. You'd be swapping a tax that's pretty economically efficient and that is tied pretty closely to the benefits that you receive as a taxpayer for taxes that are far less pro-growth, whether you're going to the sales tax, much of which is on business inputs, or if you're going to the income tax, which is on your return to labor, on your return to investment, you are shifting to incredibly high tax burdens on the things that make you least competitive. So states have really focused on tax competitiveness over the last 10 or 15 years. And this would undermine that. And some of the people who are talking about it care deeply about tax competitiveness. And I think their hearts are in the right place, but they just don't necessarily understand what this can do for their states and for their localities. So we're trying to give the whole picture. I'm publishing things, the rest of my team, we're talking to people, trying to make sure that it's not just half of a question. It's not just, would you like to no longer pay property tax? It's also, would you like to triple your income tax? Would you like the state to have the power of the purse over local finance? because I think only when we have that full conversation can we really meaningfully be talking about this at all.
And you will never find someone more passionate about property taxes than Jared. I appreciate this about you. There was a really wonderful breakdown of all of that. Like, I think it's something, obviously people kind of hate the property tax, but it's a necessary evil. I wouldn't necessarily even want to call it that, but it's just one of those things that we need. It's what currently, functions best for us. But I appreciate your passion on that so much.
All right, let's do a lightning round now. Just very quickly, I'll go to Daniel first, and then Jared. What are some stories that flew under the radar this year? Tax developments that maybe are important that taxpayers need to know about, but they wouldn't know about it if we didn't tell them right now.
Three things. Well, I guess all three of them are related to the big beautiful bill. One is that for the first time, we have 100% expensing for qualified structures, particularly manufacturing and agricultural structures. So this is a temporary provision that was brought in the big beautiful bill, but it's something that's something we at Tax Foundation have been talking about for years, and it's nice to see that in the tax law, and we'd love to see how that develops over the course of time, and we'll be tracking the impact of that provision. Another item is the changes for treatment of charitable contributions. So there's now a new floor for corporates and for individuals for charitable contributions. There's some other changes, but those are things that I think, particularly this time of year, it's worth looking at. We've got a recent article on our website that folks might want to review as they're thinking about end of the year giving. Another item, and this is, when I joined Tax Foundation, I joined to organize our international research program. So one of the things that is also, been off many people's radars, and it should be off many people's radars, is the ongoing debate over the future of this global minimum tax. There's just been a constant discussion since, I would say, late June, after what was called the revenge tax. It was a provision that was included in earlier versions of the big beautiful bill. It was dropped due to an agreement at the G7 that the U.S. system could sit side by side, is the words they use, with the global minimum tax. And negotiations are still ongoing to see how that actually pans out. But those are three things that I think have been under discussed in, I would say, the broad public.
And yet at the state level, I think because of all of the discussions around conformity to OB3 and this large property tax debate, other things have gotten lost in the shuffle, including the fact that 8 states are implementing further individual income tax rate cuts as of January 1. We just see states continuing to focus on tax reform and tax relief. So there's that movement. There's also this year been meaningful movement in a number of states to ease compliance burdens for non-residents, whether that's non-residents who are spending a little bit of time in the state, whether it's businesses out of state that just have minimal contacts in the state or have a small number of sales into the state, trying to make sure that the compliance costs aren't massively disproportional to their costs of being there doing business. There are a lot of states where if you spend even a day in the state, you have tax liability. You have to file and remit taxes. It might be a couple of dollars. It might be zero, but you have to file. And states are increasingly trying to tackle that. They're increasingly trying to make sure that businesses don't have burdens that are disproportionate to their actual tax obligations. So I think that's another good under the radar thing that makes a real difference, but no one really has a banner headline about it. And then Daniel talked about international tax, and I'll mention how international tax issues affect the states because this is going to be a significant ongoing issue. There is, of course, globally that discussion about minimum taxes. The federal government within OB3 changed what used to be called GILTI, the Global Intangible Low Taxed Income Tax, to something called the Net CFC Tested Income Tax. Necktie, as I guess we're now all calling it. I tried for a long time to stick to NCTI or NICTI or something other than saying necktie, but I have lost this battle. It is necktie. So we have necktie now. And at the federal level, I'm simplifying a bit to call it a minimum tax. I mean, Daniel might want to say it's not quite that, but there's an element in which it basically functions like a minimum tax where If you pay sufficient taxes abroad on your international activity, you really don't pay anything here. And to the extent that you pay very little abroad or relatively modest amounts, you pay a difference here. And that operates primarily through tax credits for your foreign taxes. A number of states, a decent number of states, brought in GILTI and are in line to bring in necktie. But states don't have foreign tax credits. So instead of this being essentially a minimum tax where if you had activity genuinely abroad and you paid your taxes abroad, you don't owe little or nothing to the US. At the state level, you owe on all of that international activity. It doesn't matter how heavily it was taxed. It doesn't matter that it was on activity that genuinely took place abroad, sales abroad, manufacturing abroad, completely unrelated. The subsidiary might have nothing to do with your state. States will still bring that in. And the way they do this is through apportionment. They take the U.S. corporate parent and they look at their apportionment factors just on the U.S. level. Let's say 10% of their U.S. sales are into a state. They will then use that as the factor to say all of their foreign subsidiaries, we're going to take 10% of all their sales too, even if it's completely unrelated, even if the federal government's not doing anything because they paid enough in taxes. But states potentially are doing this, in fact, are very much doing this. I think that's very questionable. It's not what the tax is supposed to be. It's not what it is at the federal level. But going back to this earlier conversation that sometimes what Congress does not work very well for the states. We now have this question in over a dozen states. What are you going to do with this? And I hope some states will see this as an opportunity to decouple from it. There's actually the risk we go in the other direction. There are some states that decoupled from GILTI, but they didn't say we're decoupling from Section 951A, which is where the relevant provision is. They said we're decoupling from the tax on global intangible low-taxed income, which no longer exists. They're decoupling from that, but they're not decoupling from necktie. So there might be new states joining this. Hopefully that changes.
Yeah, that is a pretty insane provision that seems hard to understand or legitimize in my mind. But as we're reaching the end of this podcast and the recap of what's happened this year in taxes. So I'll start with Daniel, and then we'll go to Jared and Erica. If you want to hop in at the end with something, feel free. But looking ahead to 2026, what do you think are the biggest unresolved tax questions from this year, and what should we be watching for in the months ahead?
Yeah, so the Treasury Department's working through a lot of regulatory guidance on some of the new provisions. I think with the no tax-ons, there's a lot of work that they need to do there. Certainly for the international provisions that Jared was referencing, some work that needs to be done there. Really, it's about taking the legislative effort for permanency and getting that into regulatory certainty as quickly as possible. And that's something that I know is a priority for the administration. But a lot of these things are still unresolved at this point. I would love to say that lawmakers, at the state level, federal level, around the world are going to wake up January 1 and new year, new you, wanting to do, simple, transparent, stable, neutral tax policy. But I think, in the spirit of, just paying attention to reality on the ground, I think there's a lot of work that's still going to be around questions of, the future of tariff policy, the future of these state conformity issues, the future of I would say even the new temporary pieces of federal tax legislation. We at Tax Foundation spend a lot of time thinking about the options that lawmakers have across a landscape of tax policy choices, whether that's the property tax conversation we had, corporate income taxes, individual income taxes, sales taxes, and we're going to be running through a lot of those discussions internally and always using our model to help us help lawmakers understand the impact of these policies. And we have a very full research agenda, I would say, for next year. So a lot of unresolved work, even for our end at this point.
Yeah, and at the state level, a lot of what we've already discussed, states are clearly going to spend a lot of time in this upcoming legislative session dealing with conformity questions. They're also going to be addressing property tax issues very clearly in a lot of states. And that might be legislative, where states substantially reduce property tax burdens and backfill that in some way, or potentially just tell local governments to figure it out. It may be a ballot measure, and that maybe is the bigger risk. We could wake up the morning after Election Day, end of 2026, and some state has adopted a ballot measure that says that all property taxes are repealed and then just tells the legislature to go figure it out. And that's probably not the best way to go about eliminating, say, 70% of your local tax revenue, which is the average, but that might be where we are. And then finally, I'd say we have a number of other tax issues percolating where a number of states are looking at additional taxes on high earners. They're looking at data taxes, additional digital advertising taxes. Washington and California are talking about wealth taxes. So we have some novel tax policies, maybe that would be a polite way to put it, some things that we really haven't done much, if any, of in the United States that are being somewhat seriously discussed in a variety of state capitals right now. So that will keep us very busy as well.
I feel like you're just trying to be polite because I'm from New Jersey with this data tax thing. It's not good.
It is not. And it taxes, there's a particular proposal in New Jersey, and it taxes based on the number of users or consumers that you have data on in New Jersey. But in many cases, you won't actually have truly identifying information. So every time a new IP address pings, even if it's the same person, you might have another fairly meaningful tax liability. It's going to be quite a mess. Hopefully that doesn't pass.
Yeah. Yay, New Jersey. Woo! What are we, still 49, 50th on the STCI? So we're not doing too great.
Yeah, just real quick. Of course, we'll be watching what the Supreme Court decides on the president's tariffs and modeling the implications of that. But it could lay the ground for new tariff investigations, lots of sector-specific tariff investigations, country-specific or trading practice-specific tariff investigations. So it may be quite a busy year on the tariff front in 2026 as well.
All right. Well, thank you all for joining us and breaking down 2025, which was a big year in taxes. And before we sign off, look, you know the deal. If you have any burning questions on taxes, you can send them our way. You can drop a comment on YouTube. You can email us at podcast@taxfoundation.org. You can slide into our DMs @deductionpod on Twitter. Thank you so much for listening.